This is a demonstration of problem 16.3b Stock Option Plan. The problem states that Man O' War Company adopted a stock option plan on April 30th, 2019 that provided that 500,000 shares of the $10 par value stock be designated as available for the granting of options to officers of the corporation at a price of $26 a share. The market price at that time was $20 a share on April 30th, 2019. On January 2nd, 2020, options to purchase 40,000 shares were granted to the President, 15 for services to be rendered in 2020, and 25,000 for services to be rendered in 2021. Also on that date, options to purchase 26,000 shares were granted to the Chief Financial Officer, 10,000 for services to be rendered in 2020, and 16,000 for services to be rendered in 2021. The market price of the stock was $23 a share on January 2nd, 2020. The options were exercisable for a period of 1 year following the year in which the services were rendered. The fair value of the options on the grant date was $3.20. So we'll stop there for just a minute and talk about what is required for the recording when you have a stock option plan. First of all, when the company adopts the stock option plan, there is no entry made, but I'm sure the minutes to the Board of Directors meeting contains all of that information, and there's probably also a need for a memo entry that gives the details, such as the exercise price and how many shares of stock are going to be made available. The market price of the shares of stock on the date of the adoption of the plan, April 30th, doesn't have any bearing, but the exercise price of $26 is important. The next thing, that on the grant date, when the options are granted to the CEO, to the President and the Chief Financial Officer, the important thing at that point is, of course, the number of options granted, but also the fair value of the options on the grant date, because that will be the amount that is used to determine the compensation expense. It's the fair value of the options on the grant date. Again, though, on the date of the grant, there's no entry made. So no entry on adoption, no entry on the date of the grant. But there is a need to record the compensation expense for the grants that were issued during for the services rendered for 2020 at the end of the year. So the President received 15,000 options for 2020, and the CFO received 10,000 options. So together they received a total of 25,000 options, and the value of the options on the grant date was $3.20. So we would record that compensation expense, 25,000 times $3.20, by debiting compensation expense and crediting paid-in capital stock options for that amount. Also, at December 31st, we would need to record the compensation expense for the options that were granted for the services that were rendered in 2021. The President was given 25,000 options for his services in 2021, and the CFO was granted 16,000 for 2021. So altogether, that's 41,000 options. Again, we still multiply that by the value of the options on the grant date. So for 2021, we would debit compensation expense for $131,200 and credit paid-in capital stock options for the same amount. Now, we know that they were granted the 25,000 options for the services rendered in 2020, and they had to exercise those. they had only a period of 1 year following the year in which the services were rendered to exercise them. So, at the end of 2021, it would depend on the market price of the stock. So the problem states that in 2021, neither the president nor the chief financial officer exercised their options because the market price of the stock was below the exercise price. So at that time, the market price of the stock was $25 a share. So it made no sense to exercise them because the exercise price is $26 a share. So that means that those options lapsed because they weren't exercised before they expired. So when stock options lapse or expire, we debit paid-in capital stock options for the $80,000 and we credit paid-in capital expired stock options. Remember that we don't do anything to compensation expense unless they quit before they have fulfilled the vesting requirements, and that was not the case. Now it goes on to state in the problem that on December 31st, 2022, both the president and the chief financial officer exercised their options for the 25,000 and 16,000 shares respectively, because at that time the market price was $28 a share, so it makes sense to exercise the options. So we would record the exercise of the options, the 41,000. They had to pay the exercise price, which is $26 per share, times 41,000 would be $1,066,000. They have to pay that to the company. And then we debit the paid-in capital stock options that we recorded for the compensation expense, which was $131,200, and then we issue them the stock. The problem stated that the par value was $10 per share, so 41,000 times $10 would be a credit to common stock of 410,000. Then the difference between the cash that was paid and the paid-in capital stock options minus the par value, so $1,197,200 minus the 410,000 would leave us with $787,200 as a credit to paid-in capital in excess of par common stock. And that is the conclusion of the demonstration for problem 16.3b.